Welcome to this explainer. Today, we're plugging right into a high-octane macroeconomic storm that is brewing across the globe. And honestly, it's moving faster than we've ever seen before. We're going to untangle a fascinating, highly volatile, and hyper-connected financial web that links the United States, Japan, and China. Look, if you want to understand where the global economy is actually heading, you can't just read the surface-level news anymore. You have to look at the massive chain reactions happening right now deep in the underlying data. Think of this setup as a real-time global financial thriller. The stakes? Well, there are very livelihoods, our retirement accounts, and the purchasing power of the money in our pockets. We're going to examine the tectonic plates of global debt, some incredibly high-stakes currency plays, and the sudden, powerful resurgence of the ultimate safe haven. So buckle up. The global dominoes are tightly lined up, and as you'll see, the very first one is already starting to tip.
Okay, let's dive right into this with a staggering number that basically sets the stage for everything else we're going to talk about today: $40.05 trillion. As of August 2026, this is the massive new milestone for total U.S. public debt outstanding. Now, human brains are just not wired to comprehend a number that large, right? So let's put it into a slightly more relatable perspective for a second. If you were to spend $1 million every single day since the year zero, you still wouldn't even be close to $40 trillion today. That is the sheer, unprecedented scale of borrowing we are operating under. And you have to remember, this isn't just a big, abstract number sitting quietly on a treasury ledger somewhere. It acts as a massive gravitational force. It violently pulls on global interest rates, it dictates currency values, and ultimately it determines what you and I pay for a mortgage or a car loan. It's essentially the inescapable black hole right at the center of our modern financial universe.
So with debt on this colossal, record-breaking scale, the immediate question we have to ask ourselves is actually incredibly practical. Who is actually footing the bill? I mean, think about it. If you or I run up a credit card and can't cover the balance, well, the bank eventually steps in and cuts us off. So how exactly is the U.S. government keeping the plastic swiping at this magnitude? The reality is, when a sovereign entity issues this much debt, it relies entirely on a constant, unyielding stream of willing buyers. But in our current, highly complex financial environment, one that's marked by extreme macro friction, rapidly shifting geopolitical alliances, and intense domestic pressures, that stream of buyers is no longer a guarantee. It's just not. We have to look under the hood at the mechanics of this funding to truly understand the fragility of the entire system right now. The U.S. has historically relied heavily on traditional pillars of foreign capital to keep this engine running. But as we're about to see, those pillars are starting to experience some serious tremors of their own. Now, look at the sheer velocity of this shortfall. The data we're looking at here is genuinely jarring. July just saw a record monthly deficit of $432 billion. That is an astonishing amount of money to bleed out in just 30 days. So why the sudden plunge? Well, a major factor is that previous tariff revenues have basically evaporated. In fact, customs duties actually went negative by $8.5 billion in July. Trade disputes and rapidly shifting global supply chains are taking a real-time, heavy toll on the government's cash flow. And without that income, total federal government receipts actually declined by 1.3% year over year. Meanwhile, total government outlays surged by nearly 22%, and that was driven in large part by a massive jump in national defense spending. So the gap between what's coming into the Treasury and what's going out the door isn't just wide, it's widening at an alarming, record-setting pace. And this slide brilliantly illustrates the absolute mathematical trap the U.S. currently finds itself in. The numbers here are just staggering. Net interest and entitlements, meaning mandatory obligations like Social Security, Medicare, and veterans benefits, are now eating up a shocking 98.4% of total government receipts. Stop and think about why this matters for a second. For every single dollar the government takes in through taxes, over 98 cents are already gone, out the door, just to pay the interest on past debt and fulfill mandatory entitlement promises. This is the highest level we've seen since the absolute height of the 2020 pandemic monetization. What this means in a practical sense is that every new highway, every new defense contract, every single federal salary essentially has to be put straight onto the national credit card. There is practically zero wiggle room left. So the absolutely crucial takeaway here is that the U.S. government is essentially running on fumes. To manage this massive, ongoing cash crunch without spiking long-term interest rates to catastrophic levels, the Treasury is leaning heavily on short-term funding measures. Over the past year, gross issuance of Treasury bills accounted for almost 85% of all marketable Treasury issuance. On top of that, they're out there executing some pretty complex financial gymnastics, specifically Treasury buybacks at the long end. That basically means they are buying back their own older, longer-term debt just to keep the whole system from freezing up and to keep yields contained. It's like taking out a new loan just to pay off an old one. But let's be very clear about this. This isn't just a localized, domestic, American issue. Not at all. By spending trillions it doesn't have, the US is acting as the very first very heavy domino in a global chain reaction that is radiating outward to the rest of the world. Okay, let's move along and see how this builds by comparing two drastically different financial realities that drive the global economy. On the left side here, we have the US net international investment position. Think of this as a giant master ledger of everything America owns abroad versus what foreigners own in America. Right now, that ledger is sitting at a massive $22.1 trillion deficit. Put simply, the US desperately needs foreign cash to function. Now, on the right side, contrast that with Japan. Japan is sitting on a record investment surplus of 562 trillion yen. The entire global financial system, as we know it, relies heavily on surplus nations, like Japan, recycling their capital to fund deficit nations like the US. It's a very delicate, symbiotic relationship, but the million-dollar question we have to ask is, what happens to the US if Japan suddenly decides it needs to keep its money at home? Well, the plot thickens, because Japan is feeling the heat right now, too. Notice the glaring gap in the economic data on this chart. Japan's nominal GDP is running well above their 10-year government bond yield. For the past 8 quarters, nominal growth in Japan has been hovering up in the 3 to 5% range, while the 10-year yield is severely lagging behind, recently sitting around just 2.86%. Now, in macroeconomics, when nominal growth runs this far above the yield, it is a flashing neon warning signal. It mathematically means yields must move higher. Inflationary pressures in Japan are finally becoming entrenched after decades of deflation and stagnation. And this is putting intense, unavoidable pressure on the Bank of Japan to raise their interest rates much, much more aggressively than they have so far. So why exactly does a domestic policy shift in Japan matter to an investor sitting in New York or London? Honestly, it comes down to basic human behavior and yield. Imagine you're a Japanese pension fund manager. You've spent years sending your money overseas to America just to find a decent return because yields at home were zero. But if the Bank of Japan raises rates to combat that entrenched inflation we just talked about, domestic yields will rise. Suddenly, you can get a great, safe return right at home without taking on all the inherent risks of global currency fluctuations. You're absolutely going to pack up your money and bring it back to Tokyo. If Japanese institutions start selling off their massive holdings of U.S. treasuries, a major buyer turns into a major seller. That drives down bond prices and spikes U.S. borrowing costs, exactly when the U.S. can least afford it. And we need to understand that Japan is not just any investor in this global game. They hold over $1.1 trillion in U.S. treasuries. This makes them the absolute linchpin holding up the ceiling of U.S. debt. The U.S. Treasury is fully aware of this glaring vulnerability, which is exactly why we are seeing highly unusual behind-the-scenes maneuvers taking place. For example, there are ongoing discussions right now around expanding the Federal Reserve's FEMA repo facility. Think of FEMA as a sort of high-end pawn shop for central banks. It allows Japan to temporarily trade their U.S. treasuries for cash without actually having to dump them on the open market and crash the price. It's fascinating. The U.S. is desperately weaving and dodging, doing absolutely whatever it takes to prevent their biggest foreign creditor from flooding the global market with bonds. Now, let's pivot and connect this directly to the stock market and your average investor's portfolio. With the U.S. 10-year yield nearing that highly dangerous 5% mark, which is a psychological and mathematical level that historically triggers severe market anxiety, we really have to wonder what happens to equities. Foreigners currently hold a record $24.5 trillion in U.S. equities, and a lot of that is largely driven by the recent explosive frenzy in AI stocks. But U.S. Treasury bonds have been in a brutal bear market since 2020. If bond yields break that 5% threshold because foreign buyers like Japan step back, it could easily trigger a massive algorithmic repricing of risk across the board. The logic is simple. If foreigners have the potential to sell $1 trillion in treasuries, they also have the potential to unwind a significant portion of that $24.5 trillion in equities. So, with all this friction, where is the smart institutional money moving to protect itself in this turbulent environment? Well, when we compare the free cash flow yield of the Philadelphia Gold and Silver Index against the S&P 500, a clear, undeniable divergence starts to emerge. Investors are quietly but very decisively shifting their capital into gold miners. Why? Because in this specific cycle, gold miners are the ones generating rising free cash flow. While the S&P 500's free cash flow yield has actually been deteriorating, dropping from 4.75% in 2022 to just 2.67% recently, the gold miners have surged to a positive 3.74%. The underlying fundamentals are completely flipping right before our eyes. The raw numbers here confirm a massive breakout. The spread between the free cash flow yield of gold miners and the broader S&P 500 has swung from heavily negative just a year ago to a positive 108 basis points, or just over 1% today. This isn't a blip. This confirms a major, sustained breakout for gold as an asset class. In a high-octane world where the U.S. is mathematically trapped by its debt servicing costs and Japan is forced to hike rates, fiat currencies are under immense historic pressure. Capital is aggressively seeking the ultimate hedge in this macroeconomic storm. Right now, the data clearly proves that the cash-generating power of gold equities is simply becoming far too attractive for institutional money to ignore. And finally, we have to look across to the other side of the globe, to China, to really complete this global macro picture. Look at the drastic plunge in Chinese renminbi bank loan growth here. July saw a record decline of 340 billion renminbi in bank loans, resulting in the slowest year-over-year growth rate on record. Household loans alone declined by 462 billion in just one single month. This data absolutely proves that domestic demand in China is severely, undeniably subdued. Consumer confidence is sliding, retail sales growth is slowing down. And why does this matter to us? Because when the factory of the world stops borrowing and stops buying, it sends a massive deflationary shockwave straight back across the ocean, complicating the central bank's jobs even further.
We're going to leave you with this final thought. We are staring at a world of extreme, unprecedented macro friction. The U.S. is weighed down by over $40 trillion in debt. Japan is cornered into raising rates, which actively threatens global liquidity, and China's demand is hitting record slowdowns. These are tightly packed dominoes, and the old rules of deficit spending are finally reaching their physical and mathematical limits. In this futuristic, high-octane global economy, what drastic, unimaginable measures will central banks be forced to take next just to keep the system running? It's a huge question. The storm is already here. Thanks for joining me on this explainer, and remember, keep your eyes on the data.